They can see me, but I don't think they can hear me.
Okay. So before we launch into our seller carrybacks, just a quick couple of introductions and marketing messages. On the call today from the sales side, we have Linda Federico Johnson, Robin Albert, and Brad Fisher. Lisa Williams and Val Allen were not able to join us today, but if you need any extra help or have questions after, in addition to LoveNeet, don't hesitate to reach out to your sales exec. So we wanted to let everyone on the call know that we have implemented a great new thing called Start in Here that's available for you and your clients. Rather than having to send people into one of our offices with their deposit, they can do it just like a lot of online banking is, where they can take a picture of the check and send it to us. It's called Start in Here Mobile Deposit. It works with a link that your escrow officer can send out to your client. It is only for the earnest money deposit right now. We're hoping to expand that in the future. But if you have any questions, just ask your Chicago Title escrow officer. And then this is launching on Monday, and we're really excited. This program is simply called In Here. And what this is giving our agents a view into their transaction, as well as sending out some automatic milestones through a push notification and an email when things happen, like the deposits received, the prelim is received, the appointments are set for your client signing, and when we record. So we're launching that on Monday, September 13th. And so you should start to see that on your transactions. You will have to do a one-time registration to set up your account, and you can't do that until you have an escrow with us. So be sure to have an escrow with us soon so you can experience In Here and all that it has to offer. That is the end of my commercials. So we're going to launch right into what is a seller carryback, and I'm going to turn things over to LoveNeet Baines, our escrow officer on Team Cutka, who's going to be guiding us through this presentation.
Good morning, everyone. So today we're going to be talking about seller carrybacks. We're going to go through the slides. Again, as Jennifer had mentioned, if you have any questions, feel free to put them in the chat box, and then we'll go through the questions at the very end. So what is a seller carryback? A seller carryback is where the seller in the transaction actually ends up funding the transaction and becoming the lender. So they are in charge of providing the financing. They can utilize the financing from their own proceeds, and they can also opt to bring in their own funds to cover if there isn't enough proceeds that are involved in the transaction. When would you use the seller carryback? So a lot of people, especially in today's market, people are getting creative, and they'll ask the seller if they want to do a seller carryback. If they're the instance when you would need it is if there's a need for short-term financing while other financing is put into place. So sometimes a person may not qualify at this time, but in a couple of months they would be able to refinance, pay off the seller, and then be able to get an institutional loan. So that's one instance. The other is, again, when the buyer does not qualify for traditional financing. So if the seller is open to it, they can act as the lender for whatever period of time is agreed upon between the buyer and seller. And the third reason is if the seller believes that there may be a financial benefit to them with earning interest. So, you know, there's a lot of opportunities that people have. It's an interest, earning interest as a passive income is one of those ways. So I actually do see quite a few transactions where the seller agrees to carry the loan. And it's a great, again, great opportunity to be able to earn interest. So one of the forms that you guys can use as agents in order to help us with drawing up the documents is the car seller financing addendum. And I'm actually going to go through and share my screen with you guys so we can go through a seller financing addendum. Alrighty, can you guys see that?
Yes.
Okay, awesome. So This is a sample of what a seller financing addendum looks like. This is available to you in your zip forms. And when filling out one of these, feel free to reach out to your escrow officer, myself, your broker. All of us are able to help you with filling out the details that are going to be pertinent in order for us to be able to draw the documents. Your clients, if you're representing the seller, they may want to have their attorney or CPA review the information that's being inputted into the seller financing addendum as well, just to double check everything to make sure that they are protected when it comes to loaning money. So I kind of highlighted here in green. I'm not sure if you guys are able to see it, but item 1 here, this is where you're going to list what the principal, interest, payment, and maturity terms are. Maturity terms being at what point is the loan going to be due. So the principal amount of the loan is going to be the main part of the loan. So how much are they loaning? $100,000, $200,000, at what interest rate? So you can, and the seller can honestly pick any interest rate up to 10%. California Constitution says that we're only allowed to charge an interest rate of 10%. Outside of that, it ends up being USURY. That's spelled USURY, and it's basically charging an interest rate at an abnormal amount. So unless you're a mortgage broker or your seller's mortgage broker, if the loan's being brokered by someone and we have an active license involved, then they can charge more than 10%, but maximum amount is going to be 10% when it comes to interest. And then you list your payment amount, and the clients can decide, is it monthly, yearly, bi-monthly, however they want us to structure it, we can draw up the note accordingly. Some people will say that they want to have the clients fill out a loan application. They want to have a credit report ran, which is completely fine. That's something that we actually do. We're not loan officers, so the clients would have to do an actual loan officer or seek other ways to be able to run the client's credit. So items 2 and 3 aren't necessarily things that we need, but your clients may want to have a credit report pulled for the buyer. Next up, we have the late charge. So a lot of the times, if there's a grace period whenever you have a mortgage, usually it's about 10 to 15 days. So if your clients would want us to include a late charge in the note that we draw, that information would be listed here. A balloon payment. So that's if there is going to be payments that are amortized over a certain period of time, but the loan's actually going to be due sooner. So a loan can be amortized over 30 years. So the payment would be as though you're making payments for 30 years, but your loan could be due in 5 years. So you would make your payments, and all the way up until the 5th year, then that entire balance that is left over would end up being due. A due on sale clause. That's something that I'll go into detail a little bit more later on, but essentially what this means is that the buyer wouldn't be able to transfer the loan over to someone else. So if they sold the property, they can't say that the client is the new buyer is going to take title subject to the existing loan. The loan would have to be paid anytime that the property is transferred over. Request for a copy of notice of default, notice of delinquency. This would only apply if there is a lender that is ahead of the seller. So and they would end up getting a notice from the other lender if the payments on the first loan are not made. Tax service. This is a service that one of the clients can choose to purchase. We have a third-party company that we utilize called Loretta Tax Service. I think it's about $100 for the fee. It's a one-time fee, and they will make sure that the property taxes get paid. So as most of you may know, the tax collector technically is always in first position, and if you don't pay your property taxes, they have the power to sell your property. And as a lender, if it was me lending the money, I would want to make sure that the property taxes are getting paid. That way my financial interest is protected. Title insurance. This is a box that we always highly encourage to have checked. That way the seller/lender are protected and they get a title insurance policy to ensure their lien position. And hazard insurance. I have a lot of clients that actually do seller carrybacks on vacant land. So when it's vacant land, you obviously don't insure dirt, but if there's an actual structure, then this would have to be marked and the seller would be listed as one of the loss payees or additional insured on the insurance policy. And then down towards the bottom here, I think that's about it. Oh, actually, item 16, tax identification numbers. The parties would be encouraged to share these numbers with each other when it comes to claiming interest and things like that when they file their taxes at the end of the year. So that's something we wouldn't share those numbers. The clients would have to speak amongst each other and to provide each other with each other's social security numbers. And
There's a question. Do the payments for the seller financing end up being recorded on the mortgagee's credit?
You know what? I am not 100% sure of that because the loan would show on title, but I don't know because we don't do anything to
report to the credit bureau. So yeah.
So we don't report it. And I think maybe if the seller or lender were to report it, then it would show up on their credit. But I don't actually think that a seller financing, any private financing would show up on someone's credit. But that's
and Jose has his hand up too. So when you're done.
Okay, go ahead.
So I have a little bit of experience with this, and unless the seller or the mortgage note holder reports it to the credit bureaus, it's not reported.
Okay.
That's what I would think too.
Yeah, it's not.
Yeah.
And my dad has one and he's on time, but unless it's from the seller, they're not going to be done. Now, the seller can do it. To what benefit, I don't know, but they have to do it. And I couldn't tell you if there's a cost or anything like that, but it has to come from the seller.
I think if the client were to default on their payments and at that point, I mean, as the seller, you're basically just notifying other people who may loan money or lenders. So you're kind of doing somebody else a favor by informing a credit bureau that someone isn't making their payments. But if they're, actively making their payments, most of the time, I don't see people probably reporting it to a credit bureau. And the last thing on the financing addendum will be the box to mark for recording, because there are two documents that we draw. One is a note, one is a deed of trust. I'll go into both of those items here in just a few minutes. But one of the documents that we record is the deed of trust, and that's the document that secures the financial interest to the property itself. So let's go back over to our slide. Jen, do you have the PowerPoint up? Perfect. Alrighty, so this is a sample of a note. So the note is the document, which is the promise between the buyer and the lender that they are going to pay them back. So in here, it shows when we draw the note, we list our escrow number. In the top right-hand corner, this says straight note. If there's two types of notes that we traditionally will draw. One is a straight note. The other is an interest-only note. And I'll describe the differences between those in just a moment here. So this is a straight note, which means that it is principal and interest. So in this case, we have a loan for $82,000. And it's being collected at a rate of 6% per annum, payable monthly. The payment for that comes out to $528.33. This loan is actually one that is amortized over 30 years. But as you can see here, the payment is due in 6 years. And so if we go to the next slide, down at the bottom of the note, it's going to show there's a balloon payment clause. So this means that there's going to be a lump sum balance that is going to be collected once the term of the note has completed. We can list the traditional clauses that are put into a note are if there's going to be a balloon payment, late charges, and prepayment penalties. So a prepayment penalty is exactly what it is. It, you know, as it may seem here, where you end up having to pay a penalty if you pay the note early. So a lot of what I'm seeing right now is with investors, they will guarantee a certain amount of interest to their lender. So they will say, you know, I'm going to borrow the money for 6 months. I'm going to guarantee 4 months of interest. So they can pay off the loan anytime during that 6 month period, but they have to pay at minimum 4 payments. So 4 interest payments would be due in order for them to be able to pay off the loan in full. So that's essentially what the penalty would be. With institutional lenders, I don't traditionally see this when it comes to like when you're borrowing money from a Bank of America, Wells Fargo, any of our local lenders here, you don't usually have a prepayment penalty. With business loans and commercial, things like that, you'll see it more there. So that's just something to keep in mind. It's not traditionally something that we see, but it's on the investor side and commercial stuff, you might see it there. Righty. And then going back to my comment about interest only notes, those are again something that's traditionally seen with investors where they will choose to pay the interest portion only on the note. And then at the end of the term of the loan, they will pay the entire principal back. So over the course of the loan, you're only paying interest. That principal is not decreasing at all. Whereas with a straight note, you're decreasing the principal as well with each of your payments that you're making. This is a sample of a deed of trust. The deed of trust is the document that gets recorded as an encumbrance against the property. This is what secures the note to the property. So we don't ever record a note. The note has all of the details, for example, with the interest rates, payment amount, prepayment penalties, balloon payments, things like that. But with the deed of trust, it only shows, it'll make a record who the lender is, who the borrower is, how much money was borrowed, and then other clauses such as a due on sale clause, acceleration clauses, things like that. So in this case, I don't believe it's in this deed of trust that I have here, but in the note, in the previous note from a different file, it had a due on sale clause, and that due on sale clause would be in the deed of trust. So if anyone was searching through the records, I've had a couple of clients get creative with their financing, and they will take they will take title to the property subject to the existing financing. So the thing that we have to look for, though, when people do that is to make sure that there isn't a due on sale clause. If there's acceleration clauses and things like that, we can still proceed, but we make sure that the clients understand that the loan could be called due in full if the lender finds out that there's been a transfer in the property. So again, as you can see here, this deed of trust is the short form deed of trust. These are also available on our Chicago Title Library if someone that you know is trying to create their own deed of trust. And there's 2 forms. We traditionally use a short form deed of trust. It's less than 10 pages, and it again will detail out who the lender is, the borrower, the trustee, and the loan amount. Next up, we have an amortization schedule. So if you're doing a straight note where it's principal and interest payments, this document will give you a breakdown of what each payment is going to be, how much is being applied towards the principal, what the interest is, and what the ending balance of the loan is. So again, traditionally, this is what we give to our clients when it's a straight note only, and people will use this to keep track of the payments and how much is outstanding on the loan. on our next slide here, so when the property is, a lot of people have a little bit of a misconception when it comes to seller financing or if the seller's carrying back the loan. The property is actually transferred over to the buyer at the close of escrow. The seller becomes the lender. So a lot of people think that they will equate it to like when you buy a car. When you buy a car and you take out a loan, the bank holds your pink slip. In this case, it's kind of like that, where the pink slip is basically the note and the deed of trust, though. The title to the home is still granted over to the buyer. There's just an encumbrance against the property to show that the seller, or now lender, has an interest in the property. So if the buyer borrower fails to pay in accordance with the terms of the note, the seller would have to go through a foreclosure process. I have to check with our foreclosure department on the dates, and we can have a class on this another time with foreclosures, but there's a certain time period, after a certain time period, you can begin the foreclosure process. I know that there's notices that have to go out to the borrower first, and then after, I believe you can even do it after the first payment maybe have been missed. There's, again, though, a certain period of time that has to go by, and then you can start foreclosure. You can record a notice and then go through that process of going to sale on the property.
Lavneet, there's another question.
Sure.
It's Sean's asking, is interest only note a balloon note?
No, not well. I guess you could see it that way, because the balloon payment essentially is the principal balance that you took out. So that part is going to be due at the end of the term of the note. With interest only notes, you're only paying the interest portion. Jen, can you
Usually that's for a certain amount of years, and then you start the principal part, right? At a different interest rate.
So that's where a variable rate would come into play, where you have an adjustment. Jen, can we go back to the amortization schedule? So if you see here, it shows that, like, let's look at the first payment line. So it shows the beginning balance of $82,000. The interest portion of this payment is $410. So if this was an interest only note, the client would pay $410 through the entire life of the loan. So in this case, this loan is for a period of 6 years. So the buyer and lender have an agreement that for 6 years, if this again was interest only, the client would pay $410. Now, at the end of that 6 years, the entire $82,000 is still due. So this is beneficial for the seller because they're getting interest and a payment that is interest only, that's 100% income, and they're going to get their full $82,000 that they lent back in the at the end of the life of the loan. So when you're looking at an amortization schedule, it starts out with the principal, the amount that's going to the principal is very small. And then most of the payment is going towards the interest of the loan. But as you go through and you go down, you can see here that the amount that's being applied to the principal is actually more, and the interest decreases as you go through the life of the loan. So that's if this amortization schedule is based on a straight note where it's principal and interest. Again, interest only, it's only the interest payment. And then at the end of the life of the loan, the entire principal balance is due.
And then Jose is asking, when I've done these types of transactions, I like to include an amortization schedule. Do you have any comments on whether this is best practice or not?
Yes, absolutely. That way your clients have an understanding of what to expect when it comes to the payment that they're receiving. A lot of clients, honestly, in my opinion, probably have no business doing a seller carryback because they don't understand what the process is. So for you as an agent, I think it is a great practice to help your clients with understanding the process and what to expect when it comes to when they become a lender in a transaction. There are a lot of people that do it. With people who are investors and hard money lenders, they're more accustomed to the process. But if you have, just a regular client who is deciding to get creative and they want to make a little bit of extra money with collecting interest, it's a great way to earn a little bit of passive income. But again, a lot of people just don't understand the process. So for you as an agent to give them an amortization schedule, talk about, how payments are collected and the process, that's a great practice.
And if you have the Chicago Agent app, you can give them an amortization schedule anytime you would like. There's my commercial.
And we're happy to pull one up for you. So what if there is another lender on the property? So again, with people getting very creative with their financing, I have seen where there may be an institutional lender. So let's use Wells Fargo, for example. They're going to be the first lender, but the borrower can't they can't go to Wells Fargo for the entire loan. So they may go to the seller and ask for the seller to carry back a portion of the financing as well. So Wells Fargo might have a loan for $500,000 and the seller is going to carry back $200,000. When there is another lender that's involved, when there's an institutional lender that's in first position, they have to approve of the seller being in second position behind them. Any junior financing that is happening has to be approved by the first lender. And obviously the junior financing, so any second loans or seller carryback, the seller would have to approve of them being in second position. Why is this important for your clients to know? If they're going to be in second position, that means that if they go and stop making payments to them on the first, the second loan, they're in second position. They're not necessarily going to get all of their money back when it comes to going through the foreclosure process because there's another lender that's involved too. We haven't seen these lately, but when it comes to short sales, let's say, they default on the first, they default on the second. The first lender really controls how much the second lender is going to get. At the end of the day, everybody has to agree, but when you're in second position, your risk is a little bit higher because you're not necessarily guaranteed those funds back if there is a foreclosure proceeding that happens. What are the servicing options that are available? So a lot of people will come back to us with their first payment, or the lender or seller will come back to us and say, okay, so when is escrow going to collect the payments? We actually have nothing to do with the servicing of the loan. We will draw the note in deed of trust. We will collect the funds from the clients to close the transaction. But after that, it is all between the buyer and the seller to coordinate for funds to be exchanged when it comes to the payments. So the payment can go directly to the seller. They can also opt to hire a servicing company. I don't know of any actually here locally in town. I've dealt with some with properties that we've handled on the coast. There's a couple of servicers out there, but here locally, I'm not aware of them. And that might be something that we can look into for you guys if that's something that you are interested in, but that is an option too, though. There are private servicers that will collect the payments. They would obviously take a fee. It's very similar to that of a management company. If you have a rental, they collect your payments, the deposits, things like that, and help with servicing of the loan. Next thing, can the seller sell or assign the note to someone else? Yes, they can. And this happens a lot with traditional lenders. When the servicer changes, they are selling the note and giving it to a different servicing company. A seller can do the exact same thing. I actually have a story about this one. So I had a client who was refinancing his mom's property. Mom was going to continue to stay on the loan. She had gone through a bankruptcy, and in that bankruptcy, one of the loans was included. Now, when you file bankruptcy, there still is a document that has to be recorded called a reconveyance. That document is what says that the loan is paid in full. So when it came time to, when the prelim came out, there was an additional loan that the seller couldn't remember anything about. And then after asking some questions, she realized that it was the loan that was included in her bankruptcy. We still had to go back and find the lender though. And through my research that I did, I found one of the servicers that had the note. And he gave me a demand. He said the amount that was outstanding, and it was something like $50,000. And then when I asked for the original note, he said he was going to get back to me. But he was completely prepared to sign my reconveyance. He gave me a demand, said where to send the payments and everything to. It turned out, though, that he had sold the note to someone else. But had I not asked that question, can I have the original note? There was a possibility that we would have paid this guy off, and he didn't have the loan. He had sold it to someone else. So that's where it is very important for the borrower to know who they make their payments to and to collect the appropriate documents if the loan is ever sold and if the loan is ever paid off. So a reconveyance is what that document is. On the next slide here, what if the borrower sells or refinances? If they ever go to sell or refinance, we as the escrow company would ask the borrower to provide us with the lender's contact information, so that way we can request a beneficiary demand. The lender would need to know how much money is due on the loan. So that's where an amortization schedule would be very helpful in making that determination on how much is outstanding on the loan. With investors and hard money loans where it's interest only, those are a little bit easier to calculate, but when it's principal and interest, the borrower and the lender need to keep track of the payments that have been made. So that true balance is only known between the borrower and the lender. I can take a guess, I can run an amortization schedule based on the information that's provided, but at the end of the day, the borrower and the lender have to agree upon the demand that is being made, and they provide us with the calculations on what amounts it is that we're going to be paying.
Lovenita, I have another question. It says, in the past, I've experienced the sellers that carry will usually double the market interest rate. Do you experience a norm when it comes to SF? I don't know what SF stands for. Angela.
So the norm with hard money lenders, with investors, is 10% interest only. With seller financing, it just depends. So if someone can charge 2%, someone can charge 8%. It's all up to them. The maximum amount, though, is 10%. I personally have never drawn a note where it was 10% principal and interest. Typically, it's just interest only notes that I'm doing. One of the ones recently, though, that was the seller financing, they did like a market rate. So they said 3.5%. So it just depends on your client. We can, as long as all the parties are agreeable, we can drop the note however they want, list whatever interest rate they want. But again, we can't go over that 10%. And 10% also includes points. So points is where there's an upfront fee that is like a loan fee or origination fee that's paid. So that includes that amount. So if there's someone that's charging 10% in interest and 2% in points, we wouldn't be able to do that. They would need to either reduce the interest rate to 8%, that way we can collect the 2% upfront, or figure if they can do it outside of escrow, drop their own note. But what I can do is only up to 10%. Okay. So what happens when the loan is paid off? This is another one where people, they kind of forget about collecting the appropriate documents. So if the loan is paid off, there is a document that we can prepare and record. It is called a reconveyance. That's the document that gets established of record to say that the loan has been paid in full. So in order to prepare this document, we would need the original note. The deed of trust is of record. We can always get a certified copy or just a regular copy of that from the county recorder's office. But the note is the most important document. That document is worth whatever the principal balance is on that loan, because you can take that document and sell it to someone. So it's very important that if you or your clients ever do any sort of financing, that you, and you're the lender, you have to put that note in a safe place. If for some reason you end up losing the note, you can get what's called a lost document bond. And we go through an insurance company. I actually have done this several times here with a local insurance company, Debuti and Defendus. They have a bond specialist there, and there's a premium that has to be paid. When it comes to the premium, it's 2 times the face value of the note. So if the original amount was $100,000, your bond would have to be for $200,000, and it's 1.5% of that amount. So when you get into the notes that are of a larger amount, the premium for a bond is much higher as well. If the deed of trust is paid off, but there isn't a reconveyance of record, we have to either go back to the beneficiary or the lender and ask them to come into our office to sign a reconveyance, or we go through the process of filing a bond. So a lot of the times the beneficiaries are still available to be able to sign the reconveyance. But if it's a really old loan, if the beneficiary has passed away and there's no one available to sign, no one has the documents, we have to go through the bond process. Obtaining a bond, again, you have to get the bond for 2 times the original amount of the deed of trust, and the premium is 1.5% of that value. And then the bond gets recorded with the Fresno County Recorder's Office, and then I send out a letter to the last known address of the beneficiary or the lender. The address is listed on the deed of trust that is recorded of record. So that's technically the last known address that would be of record that I would be able to find. So we send a letter there, and then we have to wait 30 days in order to allow for someone to come forward if there is a balance that is due on a loan, or after 30 days, then we can record the reconveyance. I have only had one instance ever where I reached out to a beneficiary and I didn't record a bond yet. I was going to. I decided to just mail a letter. They were here local, and they actually came back and made a demand. There was like $100,000 that was owed on the loan. These people, they all just lost touch with each other, and the sellers never went through the foreclosure process. So needless to say, the clients didn't have the money. We ended up not being able to close the transaction, but it is very important that if you have someone who is doing private financing, the document that they need to obtain after they have the loan paid off is a reconveyance, because that's their proof that their loan was paid in full. So that is going to be it for
Great.
the.
We have some questions, Levney. So one is, what are the risks with seller financing, and what are the best ways to protect the listing agent and seller?
So when it comes to protecting the listing agent, honestly, all that you can really do is have your clients fill out that seller financing addendum. And the best practice, if I were an agent, I would present it to them, go through it with them, and then I would have their attorney review it. That is probably the best way to protect yourself, because yes, your name is on it, you're helping prepare it, but there's another pair of eyes that is also reviewing the documents. And then on top of it, the seller financing addendum is just the instruction that's given to us. And then we prepare a note and deed of trust accordingly. And then on top of that, after we prepare it, we also have the seller approve the document. So if there's any corrections that need to be made, they need to tell us up front before we end up closing escrow. If there's something that they didn't agree to, I mean, at that point, unfortunately, they signed the document. They can go back and amend the note if the buyer and lender agree to it. They can do a modification, but if there's any changes after the fact, unfortunately, that's not something that we would necessarily be able to do through that previous escrow, they can always open another transaction to fix those items. When it comes to protecting the seller, one of the biggest things to do is to mark that box that says title insurance. We always advise the clients to obtain title insurance. If there's anything that I have learned from working at Chicago Title, is that you never buy a home without a real estate agent, and you always get title insurance. So your title insurance is the best way to protect you and your clients, because the title policy ensures what their lien position is, that there's no liens or other encumbrances against the property taxes have been paid, things like that. So reviewing the title report is also very important. We as escrow officers and our assistants are more than happy to go through these reports with you guys and your clients. Any questions that they might have about the exceptions that are listed on the prelim, we're happy to discuss with them and explain what it is that is going to be on their title policy, because that is their ultimate form of protection. When it comes to like collecting the payments and things like that, you just don't know what's going to happen. A buyer or borrower can default on their payments, and there's really no way to prevent something like that from happening. Someone may be going through a financial hardship, may not be able to make their payments. There's just a lot of uncertainty with that. That's a big risk that you take on when you do seller financing or any sort of hard money lending, private financing. That's just a risk that you take on. But by recording a deed of trust against the property, you're protected in that sense that if a borrower does default, then you have a piece of collateral to be able to either take back or sell the note in deed of trust. That way the customer can recoup some of the money, if not all of the money that they lent out.
And we are the only title company in the Central Valley that still does foreclosures for individuals. So there's another commercial. Jose has a question. It's when you're lender and you sell the note, should you record the transfer of the loan? And oh my gosh, this is the biggest thing now, Jose, with institutional lenders who don't record assignments anymore. So it's a title nightmare for us, honestly.
So the document that gets recorded is an assignment of the deed of trust. And that's the document that is also available on our Chicago Title Library if your clients want to try to do it on their own. I always advise the customers, though, go talk to an attorney. They will probably do a better job of making sure that something gets done correctly, and try to guide the customers through exactly the legal jargon that's listed on these documents. And so a lot of the paperwork is available, though, on our website. Unfortunately, we're not able to advise the clients on how to complete the document, even if I know how to complete it. We can only prepare documents through an actual escrow transaction. Anything that happens after the fact has to be done through a document preparer, a paralegal, or an attorney. But Jose, to answer your question, yes, if you were to sell the note, you would want to record an assignment of the deed of trust. That way it's a record who the new lender is.
And then Lori says discussing the transaction with an attorney is highly recommended. Also, a promissory note prepared by an attorney will most likely include more protection than for the seller.
Yeah, so there's a lot of attorneys so our notes are typically anywhere between 1 to 2 pages long, depending on the clauses that we're putting in. Attorneys will have more extensive notes, additional clauses, additional protection for the clients. We're happy to accept a note that is prepared by an attorney or a paralegal, a document prepared by the seller themselves. They can definitely do that. We can prepare the deed of trust that goes along with it. That way the note is secured to the property. So we do have clients who do that. If they want to prepare their own note, go for it. One less thing for me to prepare, but just make sure that you do go to and consult with someone who knows what they're doing when it comes to preparing these types of documents, because you want to make sure that your clients are protected.
And then
You
Heather's
still
asking,
have to follow the guidelines on the interest rate, even when it's prepared by an attorney.
Yes, that is correct.
and then Heather says, what does the foreclosure process look like that you help with, and what additional fees does that look like for someone using your services? And Heather, I can get you that information directly from Arlene, who does our foreclosures. I think it's 30 days for a notice of default, 60 days for the sale, if I'm not correct. I might be correct in that.
It's a lot
information.
longer than that right now.
It is.
There's some trickiness going on, but
Oh
we
yeah,
have
because
charts
of the moratorium and stuff. So, but I can get you her, do you know what her fees are, Jennifer, off the top of your
I
head?
don't, because
Okay.
it's a sliding, there's some different fees involved.
Yeah, yeah. So
I know
Heather,
that-
we can chat about that later.
I know that the fees are all based off of the face value of the loan.
Right.
It may even be just the principal balance that's outstanding.
Yeah.
So if you have a $10,000 loan, you know, the fees are, it's not very much. If you have a $500,000 loan, you'll pay a pretty penny for your foreclosure.
I think that's it for the questions.
Perfect. Well, that concludes our class today. You have Love Needs information up on the screen. Thank you so much for joining us and taking the time out of your day to learn about seller carrybacks. Your Chicago Title Sales team is always here to help, and we will be sending out this recording as soon as we can get it processed and over to you. If you need any copies of the slides or anything like that, just ask your Chicago Title Sales exec and we'll be sure to get that to you. So thank you so much and have a great day.
And remember, all of our classes are on our YouTube channel, so you can go back and when you're bored and watch one.